to another episode of the Foresight Active Advantage podcast series. With me today is a very special guest, David Paradice, the founder of Paradice Investment Management, a firm that he began in 1999. Paradice Investment Management invests in equities around the world with offices in Australia and the United States. There's a team of 50 people and approximately $19 billion in funds under management. David, welcome to the podcast.
Thanks very much for having me. Nice to be here.
Thank you. My pleasure. Many of our listeners will know who you are because you're kind of Australian equity royalty in a way.
I wouldn't say that.
Well, I can say that.
You can say that, but I wouldn't.
Okay. So, but for those that don't know you, tell us a little bit about yourself and how you got your start.
So I grew up in Scotiabank Valley and then basically started this job as I was a Pete Marwick initially, an accountant. I got to learn the basic accounting skills and also balance sheet in P&L skills. I always had an interest in finance and just the way businesses work. I just can't help myself. I just love talking about people, about how they good companies about how. So I then, after I did my profession, became qualified as an accountant at Pete Marwick. I left. I then started as a stockbroker for a while. Then I went to as a strategy consultant, and then I went to funds management. And then I started this business up in 1999, 2000. I got the first money on the 6th of March, 2000.
So what was it like beginning during almost the peak of the tech bubble?
Very nerve-wracking. So, I got the money, the first $30 million that we managed. It was a small cap portfolio from Rest, who have been a great supporter of ours over the years. And they're a great super fund. So I got the first 30 million, and I think it was the beginning of the end of the tech run, but the first 3 months up until around about April, June, July, the equity market had been motoring and all the technology stocks had been motoring. And it was super stressful for me because I was underperforming, and that first period is very significant when you start up to show people that you can deliver performance and people are watching you, and and Rest was obviously keeping a good eye on me, and all the consultants were keeping a good eye on me. I remember one day lying in bed and thinking, oh my gosh, I'm 3% behind benchmark, which is quite significant, and a few months. And I got up, I couldn't sleep, so I got up at 4 o'clock, went for a run. It was pouring with rain. I ran around Chatswood Golf Course, and I realised that I'd got my decimal points mixed up, and I was only 30 basis points, so I was pretty excited about that. And so the first period, the first 4 or 5 months was super, super, super stressful. But what happened was we kept basing our investment decisions on fundamentals, and we ended up, the tech wrap came in, and we did pretty well in that first year, and we were up quite considerably against benchmark, and allowed us to then other people started backing us, and we ended up doing quite well. But the first period was super, super difficult, especially given I had not actually put any money aside myself, and had a mortgage. And, the fund was losing, the actual business was losing money, so it was stressful. But I actually, looking back in hindsight, it was a good lesson for me. Well, not a good lesson, but it was a good thing to go through.
What do you think were the key takeaways that you learned during that period?
Stick to fundamentals. If you believe in your ability and the ability to develop big stocks, don't change that. Don't have any style drift. And I don't. You've got ways to big particular stocks, looking at cash flows, looking at their presentations, looking at moats, looking at the businesses, talking management. So, if you continue to stick to the fundamentals, then it'll shine through. You'll get these equity markets where they are quite speculative, but you need to be able to, I suppose, evolve in your thinking, but not stray away from the fundamentals that make a good investment.
Some of our viewers may not be familiar with the Australian funds management marketplace back in the late 90s, early 2000s, because today we have hundreds of boutiques and there's lots of people starting new ones. But back then, there wouldn't have been too many people doing what you were doing. It would have been quite new, wouldn't it?
Yeah, no, I was one of we were one of the first. There weren't that many that started by then, and in fact, over the first couple of years, there were some that started and some that didn't work out. A lot that didn't work out, and it's about being consistent about what you do and all that kind of stuff. So it was largely big institutions, maybe part of banks like National Mutual had a big investment. Part of insurance companies. So insurance company had investment arm, and they were usually significant investors, as were some of the banks. So it was a different marketplace. A lot of the state authority superannuation board, a lot of those, the New South Wales government pension plans are big, and they're still big actually. But insurance is not so big anymore on the investment side. They don't have separate investment teams. And I think what happened was over a period of time that a lot of the individuals felt that they can branch out, do their own thing, and if you believe in yourself, and have a go. Which I did.
Yeah, definitely, and I think it takes a certain kind of person, a certain kind of mindset to do that, because as you brought out, a lot of stress early on. You're putting maximum skin in the game. Everything sort of rests on you and your numbers, and ultimately that can be very rewarding, but it's also tough. And I guess it's not for everybody to put themselves under that kind of pressure early on.
Yeah, no, it's a lot of risk. It's not more massive amounts of pressure. So when we won our first money, and have so even to this day, people say, "Oh, congratulations." I said, "Don't congratulate me. Congratulate me in 5 years when we've delivered performance, and even upwards of $19-20 billion. I still feel the same." People say to me, "Well, we've got some money to manage," and I say, if I think the market is not great, then I will encourage them not to invest, even though I think we can outperform. We did look at setting up our global small cap operation back in 2007 when GFC was going on, and there was a lot of money around that one, which people were going to give us, but I just felt the market was not right, and so we didn't do it at that particular time, and that was the right thing to do. And we waited till we felt there was movement upwards in the equity market to do it. But there is a lot of pressure, and you take it home every day because you're managing people's money and you're in positions. It's not like if you're part of a transactional thing, like if you're a stockbroker, buying and selling shares, and making money off that. With equity management, you've got a lot of responsibility. You're responsible for a lot of people's superannuation. And one of the pleasing things that we do is that we do look after a lot of the big pension plans. So, like I said, Rest, one of the biggest member super funds in Australia, and it's great to be able to try and do well for a lot of the broader masses out there, the people out there, and we do that by managing money for these big super funds, which then obviously collect the money from these guys, and it's stressful because you want to do the right thing by the man on the street.
So if you look back now over your career as an accountant, a consultant, an analyst, a business owner, a fund manager, a philanthropist, a board member, it was a very wide and interesting variety of roles. What do you think have been some of the key learnings, the key takeaways for you across all of that?
Don't take shortcuts, So just as an example, this is probably a really good example. When I was fresh out of school, I was at Pete Marwick. I was making $9,000 a year or something. And then I used to see a whole lot of guys I went to school with and that would come from the country. They were going and they were being money market. This is back in the years when they had money market dealers and they were making 120,000, living a pretty good life. And I was so tempted to get away from where I was at Pete Marwick, learning about the basics of businesses, the industry, and go for the fast money. But I didn't do that. And I think I probably did do that when I was an analyst with a broking firm. I went and worked for another broking firm to be a stockbroker, like as a dealer. And I went there because you got a percentage of the brokerage they wrote, but then I'd lose my job, right? So so I kind of like steered off for a little while, but come back on again straight and narrow. But no, it's about not taking shortcuts. It is about doing the right thing by people. And you're right, I do a lot of philanthropic stuff. And, one of the things I support is this thing called primary ethics, which is about teaching children at primary schools about the difference between doing right and wrong. And so I think it's really important that everybody does that, that you are passionate about what you do, and that you continue to do what is right, I think, by the broader community and everybody around you.
Well, I think there's some great advice there. David Paradice, thank you very much for joining us on the Foresight Active Investment podcast. Podcast is for informational purposes only. It does not constitute financial advice or take into account the particular investment objectives, financial situations, or needs of individual listeners. Listeners should consider whether any opinions or recommendations in this podcast are suitable for their particular circumstances and, if appropriate, seek professional advice, including tax advice.